Welcome to Financial Focus, brought to you by Gulf Coast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have provided North Florida savers and investors sound, comprehensive financial guidance for over 25 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more financial focus by visiting gulfcoastfinancial.net.
And welcome into the program and this special holiday best of edition of Financial Focus, the weekly show brought to you by the best of the best in financial services, as named by the readers of the Lake City Reporter for 7 years straight. The team from Gulf Coast Financial Services, founder and CEO John Kuykendall, is our resource for that common sense approach and the clarity for the financial investment and retirement planning world. And today we are going to flash back to several of the guest interviews that we've featured on the radio program and podcast over the past year. If you've got questions or concerns about your financial and retirement well-being at any point in time, or if you'd like more information on any of the information that the guests share, you're welcome to give Gulf Coast Financial Services a call. They always love to hear from listeners to the program, clients, and those that may not yet be clients throughout the area. You can reach them by calling 386-755-9018. That's 386-755-9018, or going online to gulfcoastfinancial.net. That's gulfcoastfinancial.net. Now, first up on the program, we're going to flash back to when we featured the former Comptroller General of the United States. David M. Walker was essentially responsible for signing the checks and balancing the checkbook for our country. During his time on the program, we asked him about his responsibilities in that position, his motivations when he signed on for the position, and his motivations when resigning from the position to go on a nationwide fiscal responsibility bus tour, raising awareness of the finances of our country and polling the voting American public on the financial issues that were important to us. In his role as Comptroller General, David M. Walker obviously had a lot of insight into the inner workings and the monetary policy of the United States. He made for a fantastic interview, and we also asked him about how he personally felt prepared for the financial future and what he was doing to feel as secure as possible. David, it probably took a lot of hard work and dedication to obtain that high-level position, basically as the government accountability officer, as the Comptroller General, and you made the hard decision to step down from that position. What led to that difficult decision?
Well, when I became Comptroller General of the United States and head of the Government Accountability Office, I had three goals that I set for myself, and I had accomplished two of the three goals after about 9 years. And I ultimately determined that I was not going to be able to accomplish the third goal in that position. And that third goal being able to not just talk about the problem with regard to our nation's finances, but to be able to address sensible solutions that are nonpartisan in nature, but should be able to gain bipartisan support. So that's why I left. The mission of the GAO is to support the Congress to help improve performance and assure accountability. And the Congress generally does not want the GAO to be in the policy development business. So to the extent that you were going to be making specific recommendations about these are the type of tax reforms you need to consider, these are the types of reforms to social insurance programs, this is what you need to do in the area of defense spending, this is what you need to do in the area of government organization and operations, it crossed the line between what historically they had wanted GAO to do and what I felt needed to be done. The only one that I didn't get accomplished was to have a meaningful down payment made to be able to put our nation's finances in order. And that's where I felt you had to get into specific reforms, which the Congress didn't really want the Comptroller General to do. So I ended up founding my own Come Back America initiative, and I proved that the American people were a lot smarter than the politicians realized. They can handle the truth. They're willing to accept tough choices as long as they're part of a comprehensive and integrated plan that's designed to achieve a specific goal that they deem to be fair. So I proved that. In particular, we did a $10 million a minute tour, which is how fast the unfunded obligations and debt was going up at the time, $10 million a minute, and we were able to engage the public and gained a supermajority support for a range of budget, Social Security, Medicare, Medicaid, healthcare, defense, tax, and other reforms that were designed to achieve a specific goal. And the whole point is, if you want to solve this problem, you can't do it with an inside the beltway solution. The people need to put pressure on their elected officials to be able to come up with solutions, because the far right is going to have to compromise and the far left is going to have to compromise in order to get this job done. Now what we need is the Congress work together to operationalize. But that by itself is not going to get the job done. The president has not talked much about how do we eliminate waste in the Defense Department? How do we end up separating the wheat from the chaff between which government programs are working and which ones aren't? How do we reform Social Security and Medicare to make them solvent, sustainable, secure, while not busting the bank? And those are the things he's going to have to address. We're not going to be able to grow our way out of this problem. Debt as a percentage of the economy continues to grow. And while I agree that we need to grow the economy, create more job opportunities, we're also going to have to end up reforming health care, social insurance programs, defense spending, and other areas. And what I haven't seen is much talk about that. The fact of the matter is the federal government's grown too big, promised too much, and is going to have to restructure. If we can get the economy growing faster, that will help. But tough choices are going to have to be made with regard to spending, including social insurance programs. People need to understand that eventually those reforms will be made. They're likely to live longer than they expect. They're likely to have to pay more for health care than they expect. So they need to plan, save, invest, preserve, try to get out of debt as soon as they can so that they can have the flexibility to be able to deal with the kinds of changes that ultimately are going to happen.
Former Comptroller General David M. Walker then expanded on the conversation by discussing his greatest concern with some specific government programs.
Well, first, Social Security is arguably the most important and clearly the most popular federal program. It is underfunded by about $11 trillion. When the so-called trust fund goes to zero in, frankly, less than 20 years from now, it's still got about 78 cents in revenue for every dollar of promised benefits. So it's not like it's going to have no money, but we need to reform it now to try to be able to make it solvent, sustainable, secure, indefinitely. People may have to work somewhat longer. They may get somewhat a different amount than they think they're going to get, but they're going to get something. The real changes are going to be in the healthcare area. The government has way overpromised on healthcare. Medicare is underfunded about $30 trillion in current dollar terms. Its trust fund's going to run out quicker than Social Security, and obviously we have to end up deciding what are we going to do about the Affordable Care Act. So the biggest changes are going to come in the healthcare area, and people better understand that they're likely to have to pay more for healthcare than they expected.
To address the concerns that David Walker expressed about our fiscal policy on a governmental level, he explained what he is doing and what he feels we as individuals should do in order to help secure our financial future.
Well, you have to plan, save, invest, preserve. When you get closer to retirement, look at your investment strategy or asset allocation to make sure that you don't have as much volatility. And when you get to the point of retirement, you need to think about how do you want to convert your savings? Do you want to consider annuities as an option, which protect you against longer life expectancy than you expected? Myself, I've gotten out of debt. I've got a significant amount in an IRA. I've got several life annuities, two of which are indexed for inflation or other factors. And so I think I'm in good shape. But, that didn't just happen overnight. I had to contemplate that and take steps over many years in order to put myself in the position that I am today. And others need to do the same. I'm not worried about myself. I'm not real worried about my kids, but I'm very concerned for my grandkids' future. And that's one of the reasons that I'm still engaged in this fight to try to be able to put our finances in order, because I think what's going on now is irresponsible, It's unethical. It's immoral. We're burdening the future of our children and grandchildren when they're going to have a lot tougher competition in an increasingly competitive and global economy. That's not the right thing to do, and I'm going to do what I can to change that.
As the former Comptroller General, Mr. David M. Walker certainly has a uniquely qualified perspective on how the government will raise the capital to meet their ongoing obligations.
Well, nobody likes to pay higher taxes, especially if they don't think they're getting a good deal with regard to the taxes they're already paying. And there's no question that we can generate additional revenue through more economic growth. Most of the changes we're going to have to make are going to come on the spending side. But I believe that in time, we're going to have to end up getting more tax revenue as a percentage of the economy than we have historically. So there will be somewhat higher tax burdens over time, but the bigger changes are going to take place on the spending side, as they should. For sure, I think you need to save and invest for the future. Reasonable people can and will differ on whether or not you ought to do it through, for example, a Roth IRA or a regular IRA. The difference being is, when do you pay taxes? Obviously, most all Americans are covered by Social Security, which is the foundation of retirement security. Many Americans are included in employer-sponsored plans like 401k plans, and so those are already set up. You need to take advantage of those to the maximum extent possible, at least to the employer match. So the real decision is, what, if anything, do you beyond that with regard to an IRA, and do you want to do it through a Roth or through a regular IRA? And you can obviously talk to your people about the tax differences there.
Obviously, a great interview there with the former Comptroller General, David M. Walker. As a reminder, if you've got questions or concerns about your own financial, investment, and retirement well-being or planning, give John Kuykendall and Gulf Coast Financial Services a call at 386-755-9018. That's 386-755-9018. Next up on the program, and this special Best of Holiday edition of Financial Focus, is William Bengan. William Bengan was a financial planner who is credited with coming up with the 4% rule for generating retirement income and cash flow. In his interview, Bill reflected on formulating the 4% rule and commented on several of the factors that we must take into account as we are determining our own retirement cash flow. Determining retirement cash flow is a big part of your total retirement plan, and it is absolutely a part that John Kuykendall and his team at Gulf Coast Financial Services really help their clients to focus on and formulate a specific plan for. If you would like that written retirement income allocation plan, give Gulf Coast Financial Services a call at 386-755-9018. That's 386-755-9018. Now let's flash back to when we welcomed to the program the inceptor of the 4% rule for retirement income, William Bengan.
Great to be here.
Well, we appreciate you taking the time. Now, I know that you are retired. Do you miss the financial industry?
You know, it was a great, a noble profession. I really enjoyed the years I spent it. Fortunately, I still keep in touch with a lot of my former colleagues, so I still feel involved.
Still keeping in contact. Well, if you don't
That's right.
mind, could you give us a little history? Can you explain the original concept of your 4% withdrawal rate model? What prompted you to come up with it, and how did it work, if you could describe it?
Sure. You know, I began as a financial planner in the late 80s, and by the early 90s, I had clients who were asking me, you know, they're thinking ahead 15 to 20 years for retirement. How much do I need to save for retirement? And once I get there, how much can I take without running out of money if I live 30, 35 years or more? And quite frankly, you know, I would not remembered anything being published in that area, nothing in my CFP courses. So I did a lot of research. I couldn't find anything. So I decided to just adopt it as a research project myself, started using historical data on investment returns and inflation going way back into the 1920s, and basically reconstructed the experience that retirees would have had. And the 4% rule came out of that. What I did, I looked for the worst case that happened to any retiree, and it turned out the retiree that retired in the late 60s, 1968, 69, ran into a couple of really bad bear markets early in retirement, and then he was hit with really high inflation. And that turned out to be the situation that created the worst case 4% rule.
And with that 4% rule, can you explain what it means as far as when a retiree is looking at how much they've saved, how much they should be able to generate for that income?
Yeah, sure. Well, in terms of withdrawal, let's say you have $100,000 in an IRA account when you retire. If you use the 4% rule, you would take out $4,000 the first year, and then you would throw that 4% number away, and then each year increase your $4,000 by the percentage inflation that you experienced the year before. So if you start out with $4,000 and there was 3% inflation, you go to 4120 the second year, and so on. And the idea of that is basically that your lifestyle, your withdrawals will keep pace with inflation so that your lifestyle is maintained.
And this would give somebody a pretty high probability of success in retirement, you felt? Well,
based on history, since it was a worst case situation, it was 100%. But, you have to take that with a grain of salt because the 4% rule is not like Newton's laws of motion, which is a law of nature. It's a rule based on experience in markets, and markets could change. It's possible that in the future we might end up with something lower than 4%, but it's held for 50 years. So.
Well, since the time that you did incept and publicize this 4% rule, both the interest rate environment and the stability of the market at times have changed. I guess more so with the interest rates at present time staying pretty low for an extended period. Do these kinds of changes affect how you would predict cash flow to be created?
So far I haven't seen any effects that would invalidate the 4% rule. I've taken a look at 2000 investor who retired right when there was a huge bear market, and I've taken a look at the 2008 retiree who also retired, when a huge bear market, and both of them are doing okay through retirement. They don't appear to have any problems. And the reason, of course, is that stocks tend to recover over time. But I think the most important factor is that nowhere in the last 50 years have we had a burst of inflation like we had in the 1970s. And if you remember when I talked about how the 4% rule is used, you have to increase your withdrawals by inflation every year. So if inflation is 10% and you're increasing your withdrawals by every year, it's really putting a hole in your investments very rapidly. Without high inflation, I think it would take something really drastic, which we haven't experienced before, to invalidate the 4% rule.
So you think that the higher inflation may have more of an effect on us ultimately over time than the lower interest rates or some amount of market volatility along the way?
Yes, because we've experienced market volatility in the past. We've experienced periods of low interest rates in the past. But inflation, I think, is the greatest danger for retirees now. If we get a return to 1970s style inflation, that could be very dangerous for portfolio retirees.
I've read in other sources where you also made some special considerations based on the tax status of the accounts from which the income was being pulled. How do taxes affect our income in retirement and your 4% model?
Okay, the higher your tax rate, the higher, and let's say this is dealing with a taxable account. Okay, now the 4% rule really applies to tax-deferred accounts like IRAs or Roth IRAs, 401ks. If you're investing in a taxable account for retirement, you have to figure that it could be as much as a 10% lower withdrawal rate. And if tax rates were to go up much higher than they are today, it could be even less than that. So taxes are very important if you're dealing with a taxable account.
So where we have seen down years, where we have seen people creating income from accounts that may have taken a loss, for the individual who may have retired in 2000 and then experienced a couple down years right at the beginning, or somebody who retired in the year of 2006 and experienced a couple down years, what would your advice be for them to have confidence in their retirement?
Markets are going to fluctuate. That's their nature. They go down, they recover. I don't think people need to be overly concerned about that. The only reason they might be if they started out very aggressively and decided to take out 5 or 5.5 or 6%, and they run into a big bear market. Then they may have to have their plan redrawn based on the new valuations of the market. It's the beauty of it is that you don't have to, when you start with a plan, you don't have to stick with it your whole retirement. You can redo it every year if you want. Take a look at it, and probably should be reviewed periodically.
Absolutely. I believe they should be reviewed periodically. For some of the American public, though, that may not be familiar with you or this model for forecasting a safe withdrawal rate in retirement, I feel like some of the expectations are to be able to generate much higher cash flow in retirement, an 8%, a 10% withdrawal rate, because people look at historical returns. What would you say to folks about the reasonable withdrawal rate that you have predicted?
When I started doing this research, that was pretty much the mindset what you described. Because people would make these straight line projections and say, well, stocks will earn 10% and bonds earn 5%, so you can take out 7% and 7.5%. It completely ignores the fact that if you get a big bear market early in retirement, it diminishes your portfolio so much it can't recover. It reduces the amount of years it can last. So you cannot ignore bear markets. You can't do those high withdrawal rates with confidence, particularly if you're starting from high valuations. That's another researcher, Michael Kitcey's looked at this and he said, when the stock market is very expensive like it is now, stick with the most conservative withdrawal rate. Don't get frisky. And that's certainly what I would advise clients right now. Don't stretch. It's dangerous.
A great interview there with William Bill Bengan, the inceptor of the 4% rule for retirement income. Again, John Kuykendall and his team at Gulf Coast Financial Services helped their clients draft a written retirement income plan and really help to focus on the amount of income that you can generate from your assets, your investments, and your retirement portfolio as part of that planning process. If you would like to get a financially focused retirement income plan, pick up the phone and give Gulf Coast Financial Services a call at 386-755-9018. That's 386-755-9018. Finally, on this special Best of Thanksgiving Holiday edition of Financial Focus, the flashback to the interview where we featured industry leader Tom Hegna. Tom Hegna is the author of the books Don't Worry, Retire Happy, and Paychecks and Playchecks. John often refers to these books on the program. Tom Hegna is a well-known speaker and a retirement planning thought leader in the industry. Many of his strategies and concepts are used by planners and advisors looking to help their clients structure a more secure and confident retirement future. If you would like help structuring your plan, give Gulf Coast Financial Services and John Kuykendall a call at 386-755-9018. Now let's flash back to when we featured Tom Hegna on the program.
See, retirement's been studied in depth by PhDs all over the world. Well, I've read their research, and you know what the research says? There's really one optimal way to retire based on mathematical, scientific, and economic facts. So what I write about is the math and science of how to retire the optimal way. Nobody knows what will be the best way, but I talk about the optimal way, and optimal simply means it'll be the best more often than anything else will be the best, and it'll never be the worst. People are facing a life where most people don't have a pension anymore, and at a time when they need guaranteed lifetime income more than ever. They're living longer than ever. The market is very volatile. We printed $4 trillion. The government's in debt with $100 trillion of unfunded obligations. There's a lot to be worried about. Step number one, you got to cover your basic living expenses with guaranteed lifetime income. So figure out how much you need to live, month to month, day to day, and that should be covered with guaranteed lifetime income. So that's not where stocks fit. That's not where bonds fit. That's not where real estate fits. That's where guaranteed lifetime income fits. But then step number two, you need to optimize the rest of your portfolio to protect yourself against inflation, because you can't just have a steady income the rest of your life. You have to have increasing income for the rest of your life. That's where stocks and real estate and other things can fit. Step number three, you got to have a plan for long-term care. See, that's the one thing most people forget about that can wipe out their entire life's work. I say no retirement plan is complete without a plan for long-term care. And then step number four, the most efficient way to pass your wealth to your children and grandchildren is with life insurance. I tell people all the time, don't leave your kids any money. Spend your money. leave them life insurance because you can leave them so much more for so much less. So those were the 4 simple steps based on math and science on how to take key risks off the table and how to make sure you're going to be happy. And then I expanded on that in the TV special and the other book, Don't Worry, Retire Happy.
Author Tom Hegna went on to detail and explain some of the key financial risks we face during retirement.
If you think about it, there's quite a few risks. There's market risk. We've seen that. Markets can go up, markets can go down. If they crash right before you retire, you're in big trouble. There's withdrawal rate risk. You might take out too much money. What's the safe withdrawal rate of taking money out? There's this thing called sequence of returns risk that people don't understand. We could do a follow-up on that if you want to. We might have inflation, might have deflation. You might need long-term care. You might die. You might live a long time. There's a lot of risks in retirement, but when you study it, there's only one number one risk. And the number one risk by far, nothing if even close, is longevity risk. Because longevity is not just a risk, it's a risk multiplier of all the other risks. See, if you think about it, the longer you live, the more likely the market will crash. The longer you live, the more likely you're going to take out too much money. The longer you live, the more likely inflation will decimate your purchasing power. The longer you live, the more likely you're going to need long-term care. You see, if you retire when you're 65 and you drop dead when you're 68, it doesn't matter if the market crashes 10,000 points. It doesn't matter if inflation is 15%. It doesn't matter if you were drawing 12% a year. It doesn't matter if you forgot to buy long-term care insurance because you didn't live long enough. But if you live to be 75, 80, 85, 90, it's all those other risks that can wipe you out.
Tom continued to explain why he believes many workers, savers, and investors have been reluctant to learn about and adopt some of the fundamental planning methods crucial for a secure retirement.
In the 80s and 90s, the market was going so well. Everybody was a saver and investor, and they were investing, and they were in the market. It was all about diversification and asset allocation, and they were just making money and making more money, and the 401k was going up. Well, then 2000s hit, and we had 2 major market crashes in 2000 and 2008, and the 401ks were turned into 201ks, and then it happened again, and some people are out, they're bitter, they're never going back in. And when you're an investor and you're a saver, you have one mindset, and that's diversification, allocation, and that type of thing when you're growing retirement funds. But once you're in retirement or nearing retirement, once you get in your 50s and 60s, you can't do that anymore, okay? Because if you lose money right before or right after retirement, it can devastate your whole retirement. So once you get into the retirement phase, it's way different than the accumulation phase. If you think you're going to retire with a portfolio and just withdraw money off it, I'm telling you, that isn't going to happen. That's the way you run out of money. And so in the distribution phase, what you've got to have is you've got to have guaranteed lifetime income. You've got to take longevity risk off the table. You've got to take long-term care risk off the table. You've got to take withdrawal rate risk off the table, sequence of returns risk. So you've got to take these various risks off the table to retire successfully. And that's what the math and science shows. These aren't my opinions. These are what all the PhDs who've studied retirement say you've got to do. And it's really a simple formula once you figure it out.
Author of the book and host of the PBS special Don't Worry, Retire Happy, Tom Hegna then explained the difference between an investment plan and an income plan, and why having an income plan is so important in structuring a plan that provides for stability.
Yeah, well, it kind of comes back to the sequence of returns risk. See, the stock market's averaged 12% a year since 1924. So people say, well, geez, I'll just put my money in the market and then I'll just withdraw money out of that. Well, if you have your money in a diversified portfolio and you're taking income off, you can't withdraw 12% a year. You can't withdraw 10% a year or 8% or 6%, not even 4%. Morningstar says the safe withdrawal rate is 2.8%. But see, to some people that doesn't make sense. If the market's average 12% a year, certainly I can take out more than 2.8. And they don't understand that. No, you can't. Because if you have a diversified portfolio, I don't care who's running that. It could be Warren Buffett. If the first 3 years of your retirement, the market goes down, 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 there isn't much else I can do for you. You're either going to have to put in more, take out less, or you likely will run out of money. That's called the sequence of returns risk. And because of this sequence of returns risk, you cannot go into retirement the same way that you saved and accumulated money. And so you've got to have a base level of guaranteed lifetime income. Now, there are 3 sources of guaranteed lifetime income. The first source is Social Security. Well, a lot of people know about Social Security, but they don't know what it is. Social Security is a lifetime income annuity. It's a guaranteed paycheck for life. The second source is a pension. Now, people know about pensions, but do they know that a pension is a lifetime income annuity, a guaranteed paycheck for life? And as I said, math and science says your basic living expenses need to be covered with guaranteed lifetime income. So Social Security counts and pension counts. But whatever you're short, you're supposed to go find an insurance company and buy some form of lifetime income annuity. Now, I've been around the block enough. I've spoken all over the world. People come up to me and they say, Tom, We don't like annuities around here. Susie doesn't like annuities. Dave doesn't like annuities. Ken Fisher takes a full-page ad. I hate annuities, and so should you. We don't like annuities around here. I'm surprised. It's like, seriously? You're telling me you don't like annuities? So let me understand what you just said. You paid into Social Security for 35 years, but you're going to call up the Social Security Administration and say, stop those checks. We don't want another Social Security check in this house. We don't like annuities. Are you seriously going to do that? You worked for that company for 42 years, but you're going to call up HR, say, stop those pension checks. We don't want another pension check in this house. We don't like annuities. Well, then they say, well, I guess we like those kind of annuities. It's just those insurance company annuities we don't like. And I say, really? Why is that? Well, because they're all loaded up with fees. Really? Do you know what the total ongoing fees in a lifetime income annuity are? They're zero. It's not even a fee product. If you're guaranteed $1,000 a month for the rest of your life, guess how much you get? $1,000 a month for the rest of your life. Now, there are annuities that have fees, variable annuities have fees, some index annuity riders have fees. It doesn't mean they're bad. What you got to do is you got to weigh out what is the guarantee versus what is the fee. But basic lifetime income annuities are not even fee products, and people just don't understand that. And you can have the check continue to a spouse, you could have the check continue to a child, or you could have the check continue to a grandchild. I tell people these things can pay for 100 years. The key is to have guaranteed lifetime income to at least cover those basic living expenses. If your listeners only got that out of this interview, I'd be happy, because they would be much more likely to be happy and successful in retirement than the people who say, well, I got a broker and my broker handles all that. Oh, yeah? If they don't have some guaranteed lifetime income in your portfolio, you're likely to have problems down the road. But that's why I went into the research. You know, nobody's reading these PhDs' white papers, but I did, and then I put it into a book that people can simply understand. The Wall Street way is just put it in the market, and the market does good over time, and buy dividends and buy utilities and buy real estate. That's the Wall Street way. Well, I don't see any PhDs writing white papers on that's the way to be optimal in retirement. Certainly those things can play a role in your retirement. That's where you optimize to protect against inflation. But I don't see anybody out there saying, oh, buy real estate and buy dividends to cover your basic living expenses in retirement. That'd be ridiculous. And so I just don't think a lot of the Wall Street people understand the math and science behind a successful retirement. And I always, there's always a doubter out there, Peter, so I always give people a chance to prove me wrong. I said, here's all you got to do. If you think that I'm filling you full of bull, or you don't believe me, here's all you got to do. Put together a portfolio that has both stocks and bonds. That's all it's got to have, stocks and bonds. Take some of the bonds out, put a lifetime income annuity in. Do you know what that'll do to every single one of your portfolios? It'll lower the risk and increase the returns. And I tell people, if you don't believe me, prove me wrong. But here's why you can't. Inside of a portfolio, the way that a lifetime income annuity works, it works like a AAA rated bond with a CCC rated yield with zero standard deviation. Hey, what if you had a AAA rated bond with a CCC rated yield with zero standard deviation? What would it do to every one of your portfolios? It would lower the risk and increase the returns. These are mathematical, scientific, and economic facts.
We hope you've enjoyed this flashback to some of the best guest-featured interviews that we've had here on Financial Focus with John Kuykendall, president and founder of Gulf Coast Financial Services. If any of our guests touched on topics that you find important or you believe will be important in your financial future, give Gulf Coast Financial Services a call for a complimentary review. Also available on this week's edition of the program, the 2022 Financial and Retirement Planning Checklist. It's a quick checklist, one page with about 30 items that you need to make sure that you are addressing in your financial and retirement planning for the year to come. If you would like the checklist, or if you would like the individual review, strategy session, and a written financially focused retirement income plan, pick up the phone and give a call. 386-755-9018. That's 386-755-9018, or visit gulfcoastfinancial.net. We hope you've enjoyed this special holiday best of edition of Financial Focus with John Kuykendall, and we look forward to hearing from you soon.
Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting gulfcoastfinancial.net.
The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through Gulf Coast Financial Services Inc., a registered investment advisor in Florida. Gulf Coast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.